I put $50 into the stock market while I had $200 in my bank account. My dad called me irresponsible. My friends thought I was insane. 5 years later, that $50 became $3,400, and I discovered why Wall Street spent decades trying to keep people like us locked out. I'm Yash, and I spend way too much time analyzing why broke people stay broke while rich people get richer. Here's what I found. The advice you've been getting about waiting until you have enough money to invest is not just wrong, it's designed to keep you on the sidelines. By the end of this, you'll understand why starting with $50 beats waiting to save $5,000 and why the system fought this change for so long. This is education based on my research and experience, not financial advice. Your situation is unique. You know that conversation. Someone mentions investing and you immediately think, I can't afford that. I need to pay rent. I've got student loans. I don't even have an emergency fund yet. How am I supposed to invest when I'm living paycheck to paycheck? Everyone tells you the same thing. Save up a few $1,000s first, build your emergency fund, get stable, then invest. This advice sounds responsible. It feels safe. It's what our parents did, what financial advisors recommend, what every money guru preaches. Save first, invest later. But here's what doesn't add up. If this advice is so good, why are 49% of Americans still not investing? Why are people in their 40s with nothing saved for retirement? They're not stupid. They're not lazy. They followed the rules. They tried to save up that magical amount, and it never happened. Because here's the uncomfortable truth. When you're broke, there's always something that needs the money more than your future does. The car breaks down, medical bills hit, rent goes up. That emergency fund you're building, it gets raided before it ever becomes an investment account. You're stuck in this loop. Save, emergency, back to zero. Save, emergency, back to zero. The system wants you in this loop. Think about why. Until 2019, you literally couldn't invest small amounts in individual stocks. You needed enough money to buy whole shares. Apple at $300, you needed $300. Amazon at $2,000, you needed $2,000. The market was designed for people who already had money. Fractional shares didn't exist for regular people. Financial advisors wouldn't touch you without $5,000 to $10,000 minimum. Think about that. They needed you to have serious money before they'd help you invest it. Why? Because their business model required it. Account minimums, management fees. Your $50 wasn't worth their time. But in 2019, something shifted. Robinhood forced the industry's hand with fractional shares. Then Fidelity, Schwab, everyone followed. Suddenly, you could buy 0.14 shares of anything. Commissions went to zero, the barriers that kept broke people out, gone. The industry fought this for decades. Your inaction was profitable for them. You staying scared, staying on the sidelines, waiting until you were ready, that kept wealth concentrated. That kept you as a customer who needed their help instead of someone building wealth on your own. Here's what the data actually shows when you run the numbers. Person A follows traditional advice. They decide to save up $5,000 before investing. They're disciplined. They save about $140 a month. After 3 years, they finally hit $5,000. They invest it all. Over the next 27 years, at a 10% average return, that $5,000 becomes roughly $115,000. Person B ignores the advice. They start immediately with $50. Then they add $140 monthly. Same discipline as person A, same amount of money, just a different strategy. After 3 years, person B has about $6,100 invested. Not $5,000, $6,100. They're already ahead. By year 30, person B has roughly $113,000. Wait, run that again? Person A, who waited 3 years to do it right, ends up with basically the same amount as person B, who started broke. How is that possible? Because person B got 3 years of compound growth that person A missed. Those first 3 years matter. But here's what makes this even more powerful. Person B built the habit when the stakes were low.
When you start with $50, losing 10% feels bad, but it doesn't break you. You learn what volatility feels like. You learn that red days happen and the world doesn't end. You make mistakes with money you can afford to lose. By the time you're investing serious amounts, you've already lived through market drops. You don't panic sell because you've seen this before. Person A, they saved for 3 years and then put $5,000 into the market. The first time it drops 15%, they lose $750. They've never seen their account go down before. They panic. They sell. They learn the wrong lessons at the exact wrong time. This is the part they don't tell you. Starting small isn't a consolation prize for being broke. It's actually the optimal learning strategy. You build behavioral momentum while the consequences are manageable. But you might think $50 a month isn't enough to retire on. You're absolutely right, it's not. This isn't about retiring on $50. This is about starting the habit, understanding the system, and proving to yourself that you belong in the market before your income grows. Here's what happens when you start small. Year 1, you're investing $50 a month, $600 total. Your income increases 5%. Year 2, you're at $52.50 a month, then $60, then $80. By year 10, you're making 40% more and investing proportionally more. The habit scales with your income. Person A is still waiting until they feel ready. They never started the habit. When their income grows, they spend it because investing isn't part of their identity yet. Think about it this way. You don't wait until you can bench 200 pounds to start going to the gym. You start with the bar. You build the routine. Then you add weight. Investing works the same way. The barrier to entry is psychological, not financial. Now here's exactly how this works. Step 1. Open a brokerage account that allows fractional shares. Fidelity, Schwab, Robinhood. All free. Takes 15 minutes. You need a social security number and a bank account. That's it. Don't overthink the platform. They're all fine. The worst brokerage account you open today is better than the perfect one you never start. Pick one and move forward. Step 2. Link your checking account and set up automatic transfers. This is critical. $50 on the first of every month. Automatic. Not when you remember, not when you feel like it. Automatic. Why? Because you will talk yourself out of it. Every single month, you'll have a reason why this month should be different. The transfer being automatic removes the decision. You don't get to negotiate with yourself. Step 3. Buy a total market index fund, VTI on Fidelity or Schwab, an index fund that owns little of everything, not individual stocks, not crypto, not whatever's trending on social media. Here's why. You're learning. You don't know how to pick stocks yet. Neither do 95% of professional fund managers. Studies show index funds beat them over 15-year periods. You're not trying to beat the market. You're trying to participate in it. The S&P 500 has historically averaged about 10% annually. Some years it's up 30%. Some years it's down 20%. Over 30 years, the average works out. Past performance doesn't guarantee future results, but the data shows consistent long-term growth. Step 4. Ignore it for at least 3 months. Don't check it daily. Don't panic when it drops. Don't get euphoric when it spikes. The first time you see your account down 15%, you'll want to sell. Don't. That's the tuition you pay to learn what volatility feels like. Markets go up and down. That's normal. You will lose money some years. In 2008, the market dropped 37%. People who sold locked in those losses. People who held recovered, and then some. Your job is to keep buying every month regardless of what the market does. Step 5. Increase your contribution by 10% every time you get a raise. Your income went up 3%, your investment goes up 3%. This is how $50 becomes $100, becomes $300, becomes the foundation of actual wealth. Most people increase their spending when their income grows. Bigger apartment, nicer car, better restaurants. The investment stays at zero. You're doing the opposite. Your lifestyle can inflate slowly. Your investments inflate automatically. Here's what not to do.
Don't try to time the market. You won't catch the bottom. Nobody does. The best investors in the world can't time it. You can't either. That's fine. Time in the market beats timing the market. Studies prove it. Don't invest money you need in the next 5 years. Rent money, emergency fund, money for a car repair, that stays in a savings account. You're only investing money you can leave alone. If you might need it next year, it doesn't belong in the stock market. Don't chase individual stocks because they're hot. Tesla's up 50%? Great, you missed it. Buying after a massive run usually means you're the sucker buying from the smart money selling. Index funds remove this temptation.
Don't stop investing when the market drops. This is when it's on sale. You're buying the same companies for less money. A market crash while you're in your 20s or 30s is the best thing that can happen to you. You get to buy low for years before you need the money. And absolutely don't tell everyone what you're doing. Money is emotional. People will have opinions. They'll tell you you're being irresponsible. They'll say you should pay off debt first or save more or wait until you know what you're doing. Smile and nod and keep investing. Remember that $50 I put in while I had $200 in my account? That wasn't about the $50. It was about proving to myself that I could do it, that I belonged in spaces I thought were reserved for rich people, that I didn't need their permission or their minimum account balance or their approval. 3 years later, I was investing $500 a month. 5 years later, $1,000. Not because I suddenly got rich, because I built the habit when it was small and let it scale with my income. That first $50 is now worth about $3,400. The habit it started is worth infinitely more. You're not too broke to invest. You're too broke not to. Every month you wait is compound interest you'll never get back. Every year you spend building up to the perfect moment is a year the market grows without you. The financial industry spent decades convincing you that investing was complicated, risky, and required expertise. It's not. It's simple. Buy index funds. Do it automatically. Leave it alone. The complexity was the barrier. They profited from your confusion and your fear. Here's what this actually looks like. Start with $50 this month. In 3 months, you'll have about $165 invested. Maybe less if the market's down, maybe more if it's up. It won't feel like much. It's not supposed to yet. In a year, you'll have about $650. Still not retirement money, still building the habit, still learning. In 3 years, around $2,000. Now it feels real. Now you understand how this works. Now you've lived through market drops and recovered. Now you're ready to scale. In 10 years, assuming you increase contributions with raises, you're looking at somewhere between $20,000 to $40,000 depending on market returns and your income growth. That's not retire early money. That's freedom to take risks money. That's I can leave a bad job money. That's the next emergency doesn't destroy me money. In 30 years, studies suggest somewhere between $200,000 to $600,000, depending on how aggressively you increased contributions as your income grew. That's the range. That's what starting with $50 can become. But the real transformation isn't the account balance, it's who you become. You're not someone who wishes they could invest someday. You're an investor, right now, today, with $50. That identity shift changes everything. You start thinking differently about money. You see opportunities instead of obstacles. When the market crashes, you don't panic. You recognize it as a sale. When people talk about investing, you're not intimidated. You've been doing this for years. You belong there. The system is designed to make you wait, to make you think you're not ready, to keep you saving for someday instead of building today. Don't wait. Don't save up. Don't prepare for the perfect moment. Start messy. Start small. Start now. You don't need their permission. You don't need $5,000. You need $50 and the willingness to be uncomfortable while you figure it out. Thanks for watching. See you in the next one.